Hi everyone, this is Mayank and welcome back to my channel. So today we'll discuss about two stocks. First is the pharma sector stock and second is defense sector stock. So pharma sector stock we're taking because the management is saying there's a growth of 15 to 20% for the next 3 to 5 years. So there is a good growth journey and they're doing a good kind of capex also. And third reason the stock is debt-free stock. So the possibility the stock, it's a small cap stock basically that can convert into a mid cap stock as well based on P expansion. This is the reason behind the pharma stock. Second is the defense stock. So defense sector always in a rally right now for last couple of years or maybe 1 year. And then the budget expected that they will focus a lot on defense and then make in India. All those things are there. So based on that, defense is a sector which is a very kind of growth sector. And within the sector, this particular stock, the management is saying that they're growing at a stage of around 50% growth for the next 2 to 3 years. That's the projected revenue. And this stock has a gross margin, you can say EBITDA margin basically around 35%. So that is a very good margin if you say compared to the peer group. So considering these multiple factors, I came across this particular two stocks and we'll discuss all this information in detail in this particular video. So let's start with the first stock. So the first stock in the video is Lincoln Pharma. So Lincoln Pharma, as you can see, it's a very small cap company, only about 39 crore market cap, and the P is very much like less P, 13.9 only. And ROC ROE is pretty good, 22.5 and 17. I'll say good when I compare the peer group. And then if you see, this is the best part of the company is debt-free company, and debt is around 1 crore of debt, but the profit they're making is 93 crores of profit. Okay, and the important factor for last few videos, if you have seen, the PEG ratio is only about 1, so 1.01 is nearly 1. So this is a very important factor. So these are the few fundamentals which I first looked, and then if you go down and you see the kind of growth this company is showing, that also relatively good. It's not I'm saying it's rocket, but it's still decent. So you see last it was like if you see from March 2020 425 386 crore to 424, and then this year it was 581. Okay, and they are saying that in next 3 to 4 years they will cross around 1,000 crores of revenues. This is the projection of the company, and the profit margin is 17%, which they are saying that it will become around 20 to 22% after 3 years because of their capex, and they are moving into a branded product rather than unbranded product. So when it's a branded product means all their sales are normally through the prescription by the doctors. Because of this, they're hiring some MRs also. We'll see these things in notes. But this is the reason why this talk is getting discussed, because there is a kind of growth happening both from sales side, then they are doing growth from the margin side, then doing growth from the branding side also. So all three of them, when this comes together, the stock will get a lot of attention from the market, and there is a good chance of PE re-rating. When I talk about PE re-rating, if you go and open their pharmaceutical sector stock, and then if you see a peer group analysis, you need to go to second page to see the market cap kind of analysis. So Lincoln Pharma is somewhere here, 1300 crores of market cap. If you see Syscom Formulations, I've never heard of this company, but if you see just for the sake of comparison, their P ratio is 57.9. Okay, if you see other stock which is NGL File Chemicals, I've not on the details of it, but on the surface level comparison, 1608 market cap where their P ratio is 41.7. But if you go detail about it, operating profit margin is only 13.47, where Lincoln Pharma operating profit margin is 17.21%, which also they're going to expand in the future. Then if you see debt to equity ratio, it has almost zero, but in the case of uh, engine file chemical, it is 0.12. It still is very good, but compared to Lincoln Pharma, this is less. Then if you go for profit sales kind of thing for last 3 years, profit, engine file chemical is minus 11, whereas Lincoln Pharma is close to 14.39%. ROE, if you check, it is 16, and engine file chemical is 7.29. So it's a so I'm not saying compare with engine fine chemical, giving a comparison because the market cap are almost similar. Similarly, you can go for a SMS Pharma also. So the P ratio is 42. Here the P ratio is only about 13.93. Then if you go for your operating profit margin, this is relatively comparatively same. Debt equity ratio, they have more debt. Then PEG ratio, if you see, is 11.82, but here PEG ratio is only 1.01. And then if you see profit for last 3 years growth, it's minus 6% for Smith Pharma, and Lincoln Pharma is 14.39. So if you see all these factors, right, then you see the value which is there in Lincoln Pharma, but is not derived by the market compared to what they're giving for the other stocks. So this is the reason why I'm saying this: the growth this stock has, the kind of revenue it generates, and the potential what it has. Based on all these three factors, this stock can be re-rated and can be converted into a small cap to a mid cap if we see that kind of growth. So this is one thing. Let's go back and just check. other numbers. So if you see here, one more important factor is shareholding patterns. If you see yearly shareholding pattern, it was 33% 117. In 2021, it was 37.26%, and now it is 49.54%. So around a jump of around 12.5% in the promoter holdings. So when promoter is believing in the stock and they are buying more from the market, that means the stock has a lot of potential to grow, and they know that they are planning the company in a way that it has a tremendous growth ahead, right? FIs, if you see, they had no almost zero till 2022, okay, only 0.77%, but now they have 3.93%, close to 4% of holding. DII, sorry, didn't have any holding, but now they have 0.05%. So, and government anyway doesn't have any holding. But if you see public has sold shares from 51% to 46.49%. So this is a progression between share from public hands to promoters, and then public hands to your FIs and DIs. So that means the stock is being traded or is being considered by people who are institutional investors and promoters. So this makes the stocks attractive for me. And if you see notes, so I'm going briefly for this stock. If you want details about it, probably you can let me in the comment section. We created a detailed video for this particular stock about what they do and how they approach the market, what their future plans and everything. So in a brief, you open the notes. They are planning a capex of 25 to 26 crores and 30 crore for next year. And all their capex will fund for internal accruals. There will no debt they will take from the market. So debt to equity ratio will always be zero, at least for next 2 3 years as per the current plan. They are targeting revenue of 1,000 crores for next 3 to 4 years with a 20 to 20% EBITDA, what they are saying. And they are planning to increase their MRs to 750 to 800 in next 2 years. Right now, they have close to 60 to 70, I think somewhere around 60 to 70 MRs. And they are planning to expand their regions from tier 3 to tier 2, and then from tier 2 to tier 1 cities, the marketing basically structure. Right now, they dominate a lot on market target tier 3 cities. And the export market export 60 plus countries, including East Africa, West Africa, Latin America, and Southeast Asian regions. Commercialized products in Canada, then planning to maintain margins despite different regulatory standards, and they're going to extend the margins also. So it was right now 17%. They are saying they'll go to extend it to 22 to 22, 20 to 22%. So there are a few things which you can go ahead and read yourself. And here, as I told you, the expanding market from tier 3 to tier 1, 2, and then to tier 1. So basically, they are moving towards more branding nature of the product. So this is in brief about this particular company, Lincoln Pharma. More details we can discuss if required. You can let me know in the comment section. And so far, if you find these things helpful, if you find this Lincoln Pharma is something which you get to know, you can study further to decide whether you want to invest in this stock or not. So you can like the video, you can give your comment section, you can share with your friends and family also. And by any chance, when you use the channel, don't forget to subscribe, and that bell icon is required to be clicked so you get notified whenever I publish the video. So this is about Lincoln Pharma on a brief. So let's go to the second stock, which is a defense sector stock, which is Zen Technologies. So Zen Technology still is like a kind of a small cap, and will soon become mid cap stock kind of thing if the growth continues. The P is very high, almost 86.3. So this is not recommended P to buy a stock, but with the ROC they have and the ROE they have and the kind of growth they are projecting a growth of 50% CAGR for next to 2 3 years. So the normal what standard P, what market suggests, or what a lot of other people say, like the people who are in the market from next 20 25 years. So they the P ratio what we can pay is normally around 2x of the growth. So if the growth is 50% CAGR, then we can say up to 100 is a justified P for this kind of companies, which is a more of R&D focused company. So Zen Technology is not a manufacturing company. They are a IP based company who do all the research and R&D and then create something and then outsource the technology to all the different manufacturers, and then they create a product. So it's an IP based company. So for an IP based company which doesn't have any hard asset or it doesn't have any high debt, so for those kind of companies 2x of the growth can be given as a P. So 100 is something which we can say it's still kind of, we can consider this a stock. Debt wise, a debt free company, they have only 2 crore of debt, but profit is 130. If you see PEG ratio is little bit higher, like 1.5 is something which I consider, but 1.52 is close to 1.5, so maybe we can give a chance to this stock. But again, at any point in time, this is not a recommendation. I'm just trying to discuss the brief of the stock. So if you see there, this particular thing, profit and loss. So this year they made 440 crore of sales. Last year it was 219 crore of sales. Previous to that, 70 crore of sales. So and they are saying that this year they're going to do 900 crores of sales, and next year they're going to get it 1300 crore of sales, and after that FY27 they're going to do 2000 crores of sales. So that is a 50% CAGR they are going to grow. The net profit margin is 35%. Sorry, around EBITDA is 35%. Net will come around 30%. So they are saying this is something which they are going to maintain. This might also increase because the constituency of the entire sales, the export is taking a major jump compared to their domestic sales. And when export sales are more, the margins have more in the export and less in the domestic. So blended margin will be more than what they have right now, as and when the export contribution to the sales is more compared to domestic sales. So, but to ease of calculation, you can put 30 as the net profit, and the sales is 2000 crores, what they're saying in FY27. So, if you put those kind of numbers, we'll see the calculation kind of thing. One more thing you can notice over here, the stock price CAGR for last 3 years is 138%, where profit growth CAGR is 257%. So this is also, it's, I'm not saying it's something which we have to take it, but this is also something which we compare sometime. Stock price CAGR is 60% for last 10 years, where profit growth CAGR is 112% for last kind of 10 years, right? So this is what in terms of numbers. Now let's do a back of the envelope calculation to see what happens when this company achieves all these targets. But before that, so what this company does, in its nutshell, I told it's IP based company, but it has two divisions. One, it does to sales, and second part of sales is the operation O&M, basically operation and maintenance cost for the products it sells. So it sells two kind of products. Basically, it's a training simulator which helps the defense people to train themselves without actually going to the field and creating an entire setup where they have to train and everything, because that's a cost. And second, what the product they do is anti-drone setup, like equipment for anti-drone mechanism. So anti-drone, in the sense when somebody attacks the drone, they will detect the drones. So it's a drone detection technology. Let's now do the back of envelope calculations. If I open this particular Excel sheet, so let's see they have around 8.4 crore is the floating share, and right now they have a profit of around 30%. So let's go in the Excel sheet and see. So if their revenue touches around 1300 crores, what they are saying, and net profit becomes 30% of that, so comes around 390 crores, right? And earning per share is basically 390 crores divided by their number of shares. So number of shares is, I think it's 8.4 crore, so it's become 8.4, right? So your earning per share becomes 46, and if we consider the forward P, that is about FY26, then let's suppose you give the conservative P of 60. So if you consider P of 60, so I'm saying a particular, I'm considering a base scenario. Okay, so I'll just remove from here, and I'll consider it's a kind of, I am considering it's a bear kind of, base kind of scenario for this company. So target will somehow will become close to your, this is the P, and your number of, so you got earning per share of 46.4, and this is the P. So the P becomes close to 60, right? And earning per share is 46. So your target becomes 60 multiplied by 46. So this is your base case scenario. If the P is 60, in the base bear case scenario for FY26, so this is basically FY26. I'll write over here FY26. So if you see this kind of scenario, and if you consider a bear case scenario of 40 of P, which is for defense sector, and this government is focusing a lot on making India and defense sector a lot. So I can say 40 is something which is considered as bear for this kind of company. So 40, if you see, then this becomes similar to this particular company, right? So it's 1857 is the bear case. If you get the bull case scenario, then it will give P of 70. So P of 70 is somewhere here. So if you consider P of 70, then it becomes somewhere like that. So if you change to P, it will become 3250. So that is the bull case scenario for FY26. Now let's go to FY27. Sorry. FY27, if I copy the entire thing over here, FY27, okay, sorry, I'll just copy this entire thing here. And the profit or revenue they're saying is 2000 crores, right? And net profit will become 600 crores, 30% of that. And earning per share is 71, forward P is 17, efficiency target becomes 5000, the bull case scenario. Base case scenario, we'll just copy the same thing over here and it will change. So if you see here, the base case scenario becomes 4285, and bear case scenario will become somewhere close to 2857. Now bull based bear case scenario is not based on company earning, it's based on the market. So company is very confident that they will do these sales. They might cross also, but they're 100% sure that they will get this kind of revenue, because in the Concall letter people have asked multiple times whether you can achieve the growth target what you're saying, and they are pretty much confident every time that we'll definitely do that. We know the market. So if you consider they reach this and the market doesn't give them the value what they have right now, but still on the bull based bear case scenario, this is the price. So if you see with the current price 1296. So if they compare the current price 1296, even the bear case scenario you get a 50% return. In the case of bear case scenario, it's almost 2.5 times. The case of bull case scenario is close to 2.5 times. In the case of bear case scenario, is close to double. Base case scenario close to double. Similarly, if you go financial year 27, then in the case of bull case scenario, almost you get 4 times of return. In the case of base case scenario, it's close to 3 to 4 times. And in the case of 3.5 times, like a base scenario, in bear case scenario, is close to 2.5 times. So this company has a very good potential in terms of growth. Okay, and this is only because the company is projecting 50% growth, and that's why I'm saying if company is 50% growth, 100 P is justified and can be given. So if you consider that kind of scenario where the P doesn't change, it remains something like which is right now. So that's a very different scenario. I'll just try to copy online and see what happens when we give the P what this company has right now, which is close to 84, 86 kind of thing. So let's do that. 84, then the price becomes 6,000, which is almost 5 times than what is the price right now. So it's a huge growth potential. Now saying that this is only a calculation, this is not a recommendation that price will go or projection kind of thing. This price will go this much. So it's again detail wise we can discuss sometime else. Everything what is training simulation, what is the market, which countries they're targeting, what is counter drone solution, which country they are targeting, all those things we can discuss. But in a nutshell, this is what Jet Technologies, and this is what your Lincoln Pharma is. Video about Lincoln Pharma, and this is the video about Gen Technologies. So both these stocks are a good opportunity. One is more longer in nature, which is Lincoln Pharma, and can you P expansion re-rating kind of thing. Other one Gen Technologies, which is completely based on their growth projection. So these two are videos, not a recommendation at all. But if you think this video helped you to find something which you can research more, and then you can decide whether you can invest or not, then do like the video, do share with your friends and family. And if you have any feedback for me regarding video, regarding the content, or regarding the stocks also, please give in the comment section. Help me a lot to improve the video and provide the content what you are looking for. Thank you so much for watching. Stay happy, stay safe.